So you're finally ready to take trading serious. You finally want to learn how you can get started in Forex trading and actually change your life for the better. Well, you have found the right place, and I'm happy that I can bring this to you. I'm probably the only trader that's ever gave this much sauce into bringing you a firm foundation. It's a great foundational structure for your Forex learning and your Forex trading. After watching going through this video completely and actually taking notes and actually receiving what I'm giving to you, you'll be able to build on the advanced concepts and all the more mesquite institutional concepts that I actually teach in my mentorship onto this strong foundation. That's why it's important to build a strong foundation, because if you just start stacking stuff, you don't really know what you're doing, then it's easy for you to crumble. It's easy for you to contradict yourself and getting in and getting out of trades. It's so easy to feel so complacent and stuck and be working so hard for a year and have nothing to show for it. But when you actually build a firm foundation, which this video is, in your Forex learning, your Forex trading journey, then you'll be completely good. So make sure you follow me on Instagram to stay updated, know what's going on and know what I'm doing. And make sure you subscribe, like, and share this video to a friend, because this video is going to change so many lives. And after you finish this full video, I will see you in the mentorship. Let's go. So you're wanting to learn Forex, and we are just going to get straight into it. There's no point of delaying anything. I'm really excited to bring this course to you so you can really just hit the road running. Obviously, there's always going to be more learning and more understanding as you continue your Forex journey, but I'm happy that I get to be the one to show you the ropes and get you started, because a lot of people don't even know that the Forex market, it trades over $6 trillion a day. Just imagine, like, for yourself, tapping in just to that bit of 6 trillion. I don't think you understand. It's $6 trillion a day, not $6 trillion a year, not $6 trillion millennia. It's $6 trillion a day. Meaning, what if you could just tap into a bit of that $6 trillion a day every single day and change your future, change your family's future? It's crazy, right? And I understood that when I first started in around 2014, which was 10 years ago. That's crazy to say. I started in 2014, and I've been consistent on the charts for the since 2019, actually profitable. So during 2014 to around 2019, I was in high school and a bit of college. And then when I was able to drop out and really focus on trading, because that's what I wanted to do. I didn't really want to go to school anymore. I really wanted to focus and just keep my mindset on trading the charts to really establish a good foundation for me financially. I had a lot of ups and downs, but it was because I didn't have anywhere to learn. I didn't have anybody to ask questions. I didn't have a mentor. And so it led me really losing a lot of money, losing a lot of time, just because I didn't have somebody to hold my hand. And I now am reaching out to hold your guys' hand. So I'm really excited for this. And so Forex, it's the most liquid global market. It's the most liquid market globally. I don't think you understand. Like, the market you want to be in is 100% Forex. I won't say it's easy, but it's easy when you learn, if that makes a lot of sense. It's easy when you learn. So it's easy to enter to a trade, and it's easy to get out of a trade quickly. You don't have to spend a whole bunch of time into a trade if you don't want to. You can hold trades for months, weeks, or you can hold trades for seconds, minutes, hours. Me personally, I just do a few minutes. And the thing is, in today's age, it's so accessible to anybody to trade. Whether you have $100,000, whether you have $100, whether you have $10, there's so many different resources out here to where you can trade without any risk of potentially losing thousands and thousands of dollars of your own money. And I wish I knew that early on, or instead of all this, it would have just been. But because nobody's aware of that stuff and nobody's really telling you, then how do you know? You don't know what you know. I mean, you don't know what you don't know until you know, So the sky truly is the limit when it comes to Forex trading. There is no cap on how much you can make. It's not like, oh, I can only make $100,000 a year. Oh, I can only make $1 million a year. You can make however much money you want, whatever your setup permits you, whatever your leverage permits you. You can trade as much as you want, as frequent as you want, and the sky is the limit. I'm telling you. But the thing is, you do have to understand, it is not a get rich quick scheme. I'm not promoting that you'll get rich quick. I'm not promoting that you'll be rich in the next 3 months. I am saying you can shake some things up in the next 3 months. I'm not going to lie to you. You can definitely change your life in 3 months, but I'm not saying you're going to be rich in a couple days or even a couple months. It is truly something that you have to, it requires a lot of discipline. You have to have a strategy, and there's a consistent learning behind that. And you do have to set realistic expectations with yourself, because when you set such crazy things that aren't really achievable or aren't realistic, then when you don't hit that target, you get really, what's the word? You get really discouraged, and it can mess up your trading journey. You can be really emotional when when it comes to trading. You can really lose focus on what's important in trading, and that's really just sticking to your system, sticking to your strategy consistently, right? You want to be disciplined consistently. You want to take the same trades that you've been taking consistently, but when you're setting these crazy expectations, you begin forcing trades. And we're going to go all into psychology. We're going to go all into trading and how it really works. But when you're setting these high expectations, it's easy to fall short and really hurt yourself, because you start forcing trades, seeing things that isn't there, falling off from what you believe in your concepts and how you trade. But the profit potential is there, and you can make a lot of money. You can make infinite amounts of money, but at the same time, concerning your leverage, concerning your discipline, concerning your experience on the charts, concerning your money in your trading account, concerning how you set up and how frequent your setups happen through your strategy and through the concepts, that determines, the expectations that you can set for yourself. So definitely set those expectations. It's not a get rich quick scheme. It's not something that, when everybody hear Forex, right, they think of the MLMs. Like, no, bro, that's not Forex. It's getting somebody to sign up for something, and you sign up for something so they don't got to pay. Then they sign up under you. Then they sign up under you. That's not Forex. All that is multi-level marketing. You hear me? It's not Forex trading. It's just multi-level marketing. Forex trading is when you are actually on the charts, right? It's not just, it's something that actual skills have to be gained. Skills that'll be developed, consistently work on, consistently hammered on through chart hours, because practice makes perfect. It's not like I teach you everything, okay, go run, go crazy. You have to do your own due diligence. You have to do your own soul searching to really apply yourself on the markets, apply yourself on the charts, because it's so easy to get discouraged when you think somebody told you something, it works for them, but it's not working for you. But it's because this thing has worked for them, because they put the time in for it to work for them. I always say all works. It's either working for you or it's working on you to turn you into that person that it needs to work for. So you keep putting the chart hours and keep being consistent on the charts, and you'll be good when it comes to that. So you are going to learn a great bit in this course. This is going to be, what is it? It'll probably be about 2 hours, 3 hours course. You're going to learn the basics of currency pairs. You're going to understand Forex market hours and sessions. And I'm going to give you like little sauce here and there just to get you going, keep you excited about the markets, to show you how predictable and how consistent you can catch the same thing every single day. I'm going to do like an introduction to the pips, lots and leverage on the charts, which is very important. You need to know how to calculate it, because that's how you goes into the next thing, which is your risk management. So you need to know those things. We're going to be going over basic charting and technical analysis, as well as we're going to be hitting on introduction to fundamental analysis, risk management basics, trading psychology, which is huge. And I feel like I have one of the most unique perspectives when it comes to trading psychology. Reason being, I lost everything multiple times, and I know the tricks around it and little hacks, as well as what you really should be thinking when you're trading. We're going to be hitting setting up a trading plan for you, because you need a trading plan. It's important to have a trading plan, and obviously it can't be that personalized because I'm not working with you one-on-one, but I'll give you pretty much a general personal plan, why it's important, key components of it, so you can kind of build your own. Obviously it's not going to be perfect, because you may or may not have experience when it comes to trading and when it comes to creating a personal plan. So I'm going to do a general one and, work it to the best of your ability. We're going to do like an intro to demo trading. Now I think my perspective on demo trading, I think it's so powerful, and it's realistic. Like, everybody knows demo trading is like paper trading. It's trading with fake money, but I'm going to show you how to take that fake money into real money. So we're going to be touching on that. We're going to be going over the common Forex mistakes to avoid. We're going to be, as well as what your next step should be after you finish all the contents. So I do encourage you, when listening to this course, when I'm showing you everything, you need to be re-watching things over and over. Sometimes I want you to watch a video or a segment, right? And I want you to go back to the charts. I want you to go watch that segment, go to the charts. Can you see what I'm talking about? Can you mark up the things that I've marked up? Can you scroll back on the charts and just kind of see, like, can you just scroll back on the chart and see, okay, I see what he was talking about here. Oh, this happens here. Oh, the markets are doing that there. And as well, I need you to take notes. You have to be taking notes. So this is like something that's really engaging, and you have to be real active in this course, you know, to give it to your best ability so you can actually learn what I'm teaching. Also, make sure you let me know in the comments. I want to know what brought you to trading. How did you find this course video? What are you excited to learn? How far are you in your journey? Are you somebody? I believe everybody should watch this, whether you're expert, whether you're a beginner, because sometimes you can get to a place in your trading where you feel comfortable and you lose your edge, and then you feel like you need a reset or a restart. And I've been there before, where I felt like I needed a restart in my learning to actually know how to build a great foundation, because, you know, nothing can stand on a weak foundation. You need to be able to stand on a firm foundation. That's one of my favorite songs. God is a firm foundation. But you got to be able to stand on a firm foundation. If you don't have a strong, firm foundation of knowledge, then it's like when certain things hit you, certain things contradict, then you will crumble and you'll fall, and you have nothing to go back onto. You have nothing to stand back onto, because you never built a firm foundation. You never built anything strong. Sorry, just trying to make sure. So the people that trade Forex, it can be your everyday people like me and you. We're considered retail traders, and the retail traders are just like the individuals that trade, right? But you'll hear a lot of times in retail trading that like, oh, I'll never trade like retail, blah, blah, blah. But what that's saying is, don't trade like majority of people, because when you trade like majority of people, you're most likely going to win, because the majority of people actually lose in Forex. Not everybody wins in Forex. That's a bad misconception. And trading is not for everybody, but you don't know if something's for you or not unless you apply yourself undividedly, meaning you're putting your whole effort into it, and you believe that it can work for you. And the cool thing about trading is, and a trading strategy is, everybody's personality is different, and there's so many different ways you can make money on the markets in trading. There's not a one size fits all. There's just so many different strategies, so many different things that you can apply to the charts to make money. That's the beauty in it. So you have your retail traders. You don't really want to trade like retail, even though we are retail, but you don't want to trade like majority of the traders. That's why I discourage watching a whole bunch of different YouTube videos, because they could be called retail traders. There's banks that trade. Banks trade. The markets are heavily manipulated. I ain't gonna lie to you, but banks trade the markets. Financial institutions like hedge funds and wealth firms, they trade the markets. And government entities, they also trade the market. So it's not like we're just trading the markets. It's not like we don't make up the 6 trillion. We're probably like what is it? Maybe like a couple ounces of water into the ocean, right? Because when you think $6 trillion a day, I'm sure all the retail traders, we're not even a dip in that 6 trillion, most likely. So we're definitely like a couple drips of ounces of water in the hugest lakes or the hugest ponds, because we're so small, right? The thing that moves the charts really are the big dogs. The big dogs, they make the money, they move the markets, they make the markets. So we're very, very small. That's why it's like, quote unquote, in a way, infinite amount of money on the charts, because it's such big players playing on the markets. So these currency pairs, they're basically, you make money on the discrepancies in price when price goes up and price goes down. So like Forex, for example, is foreign exchange currency, right? So say, for instance, you have USD JPY, like we see on the charts right here, USD JPY. It's the US dollar versus the Japanese yen. Basically, so when the US dollar is doing good, what will happen? Prices go up. If the Japanese dollar is doing good, prices go down. If they're both doing bad, it may consolidate. If they're both doing good, it may consolidate. So I don't really want you to be focused on that per se. I want you to focus on the market structure. You can always trade news. You can always trade what's going on in the economic global plan and whatnot. But I believe in my philosophy when it comes to trading that all that is the outside noise. That's just a boost. It's a speed to do what was already going to happen on the charts because it is all algorithmic and it's all created. The charts are all created by an algorithm. I'm just letting you know that now. So these pairs, there's so many different pairs you can trade. If you look in the top left corner, there's so many different pairs you can trade. You can trade USD JPY. For instance, I just want to show you a few. So let's click Forex. And all what I teach you can apply to these other commodities and instruments like indices, bonds, or whatever. So you have GBP USD, that's Great Britain pound versus US dollar, Euro USD. You have GBP USD. Oh, I already said that. GBP JPY, Euro USD, GBP USD. So you see, there's all these different pairs. All the concepts will apply to them all, but you have to find what pair you like. And the only way to see that is by trying them out. And so the different pairs, they have different tendencies where they move just a little different from each other. But again, that's through chart hours and seeing over and over again how it moves in what way. So don't think it's a get rich quick scheme or anything like that. This is something that's fun. It's exciting. If you really work on it, then you can really make a living for yourself. And it's definitely a great opportunity. It's something new. And if you're not familiar with trading, it's something you definitely want to be a part of. And it's definitely exciting. I'm not going to lie. It's exciting, especially when you're learning something new that could potentially change your life. If you take it serious, you have to take it serious. If you don't take it serious, then it will take you as serious as you take it. How about that? As serious as you take trading, that's how serious it will take you. So, like I said, the success, it requires discipline, strategy, and consistent learning. You have to be consistent. And I always recommend getting a mentor. Have a mentor. Get a mentor that can hold your hand, because why learn from your own mistakes when you can learn from somebody else's? That cuts years off, as well as saving you thousands and tens of thousands and sometimes even hundreds of thousands of dollars, just because you learned from somebody else's mistakes rather than going through the hardships and the mistakes yourself. Because when you go through your own mistakes, what are you doing? You're losing money. What else? You're losing time. You're losing energy. You're losing effort, and you're only getting older. So the older you get, the less energy you have and the less effort you have to put into these things. So that's why I say learn from somebody else's mistakes. So trading Forex, it can change your life. It's not a get rich quick scheme. It takes real skill. The charts are manipulated. It is algorithmic. The instruments you do trade on the charts, you have to try them all out. You have to test them out. Retail trades, financial institution trades, banks trade, government entities trade. Everybody's making money on this $6 trillion market daily. This $6 trillion daily market. Everybody's making more and more money. So with my 10 years of experience, I'm going to give you some sauce in this course so that you can change your life. I'm going to just pour, try to give you guys some value so you can get onto the start in your Forex journey and actually make money and change your lives. So let's get into the course. In the next segment, you will be, let's see, the next segment. Oh, yeah. In the next segment where we're going over basics of currency pairs. See you there. So welcome to the next segment. We're going to get straight into the basics of currency pairs. So as we know, Forex trading involves exchanging one currency for another. So usually with the aim of profiting from currency fluctuations, Forex stands for foreign exchange. So the 4 is foreign, and then X is for the exchange part. So that's what Forex stands for. And so it's globally traded 24/5. So it's not a 24/7 market like crypto, or what else is a 24/7 market? I think that's it. I think crypto might be the only 24/7 market. If there is, I can't think of anything on the top of my head. But you'll basically be trading like Monday through Friday, right? Kind of, quote unquote, like a 9-to-5 job, but it's a 24/5. So it's not 24/7 where you trade on the weekends, but it is open for those 5 days. But I don't recommend, obviously, trading every single moment of the hour, because we'll get into the best time to trade and when to trade and why to trade during that time. Talking about kill zones, talking about just liquidity and etc. Things like that. I'm not gonna bombard you with too much information because I need you to soak in the basics first so we can build this firm foundation so we can start adding the advanced stuff way later. So what are currency pairs? Currency pair, it's a combination of just two currencies that are traded against each other. Like we talked about, euro and then USD. So the first currency is the euro dollar. It's a euro. So that's called the base currency. And the second currency, USD, it is the quote currency. So when you trade euro USD, you're essentially buying euros while selling dollars or vice versa. I know it kind of sounds weird, but trust me, all that technical stuff is kind of important to know, but it is just great knowledge to have. So, or vice versa. So the quoted price shows how much 1 euro is worth in US dollars. So if we actually look at euro USD, so you see we're at $1. So let's see, we're at $1.07 and then like 88.888 whatever. So that's how much $1 is a euro worth in US dollars essentially. So 1 euro is worth 1.0788 in US dollars. So that's basically what that's saying. So remember, the euro is so whatever's first is that base, and then whatever second is that. But behind the slash, I don't know if you can see it in the top right left corner, behind the slash, that is the secondary. So there are major pairs, there are minor pairs, then there are exotic pairs. Me, I stay away from exotic pairs because I'm like, I don't really see a point in trading every single instrument. It's like one instrument, and when I say instrument, I'm talking about Forex pairs. So one Forex pair, it can pay you. Oh shoot, sure just went down. One Forex pair, it can pay you. You don't need to know every single pair. You don't need to trade every single pair. You can trade one pair and make millions of dollars. Why? Because it's a $6 trillion market and it makes moves and it has the money on there. You can make money from one pair. So I think it's important to explore different pairs. But at the end of the day, I feel like when you get settled and feel like you got a model and a strategy, stick to one pair. There's no point in jumping around, hopping around. Maybe trade 1, 2, max 3. Please cut it off at 3. I do not see anybody consistently profitable trading more than 3 pairs, honestly, because it's unnecessary and it just opens yourself up to more risk, because you can be consistent on one pair, meaning you can be consistently winning on one pair, right? You decide to trade Euro USD, you're consistently trading, right? And you're making money. Then you want to go on to trade USD JPY, which is US dollar versus the Japanese yen, right? You want to go and trade that. Then you lose. You're like, oh man, I lost. Dang, maybe I should just stuck to Euro USD. Then you went on GBP USD. Then you're like, oh, okay, cool. I can trade you GBP USD then. Then you go and lose a couple times Euro USD. Then you're like, oh man, maybe I should stick to GPSD. Then you take a loss. Then you're just scatterbrained and you don't know which way to go, and you're doing this, you're doing that. And it can be a lot. It can truly be a lot. So we're going to go over major pairs, minor pairs, and then exotic pairs. So basically, the major pairs, they're the most liquid per se. They move the most and they have high liquidity. So these pairs include like US dollar alongside the strong currencies and are most actively traded due to the high liquidity. So most people trade them because of the high liquidity. That's why we call them the major pairs. So your major pairs would be Euro USD, USD JPY, GBP USD, and USD Chef, which is Swiss franc pair. So USD CHF. So the key points. So major pairs, they generally have lower spreads, meaning there's a less difference between the buying and selling price, which makes the cost more effective. So you have your bid price and you have your ask price. The space between there is called the spread. So say you place one lot, we didn't get into that yet, but say you place one lot, right? And you enter a trade and it has a small spread. So maybe once you buy, immediately you're down maybe a couple cents. But then if you have a larger spread on a different pair and you buy that with the same lot, you might be down $1 or $2 because of how big the spread is. So spread is bigger or smaller during the time of the day. I do want to put that out there. So let's move to the minor pairs. I used to trade minor pairs. I don't have a problem with minor pairs. They do move. So these pairs don't include US dollar, but they feature other strong currencies. So like a couple are Euro GBP, which is the euro versus the British pound, and then you have the Euro AUD, which is like the Euro Australian dollar. Then you have GBP JPY, which is Great Britain versus the Japanese yen. And so the minor pairs, they have less liquidity, meaning they do move a little less, but they still move nonetheless. Hey, I'll be spitting bars. Um, the spreads, they are bigger than usually. They are a little bigger than your major pairs. That's something you can look out for, but generally speaking, when you have a good setup, when you see the setup you want to take, spread doesn't matter really too much as long as you're not risking crazy money. Spread doesn't really matter that much as long as you're not trading crazy times of the day either. So if you're trading during the times I tell you should be trading, then you'll be good with that. I promise you. You'll be perfectly fine where you don't really have to care about the bid and ask price. And then you have your exotic pairs, which are nutty. I don't really trade. I've traded exotic pairs, but only when trying to gamble. I don't trade exotic pairs. I don't touch them. But you got like US dollar versus Turkish or ZAR and Euro Sekadosha. You got like there's a whole bunch of random stuff. It's crazy ones. But you can do your own, like looking them up and try them out if you want to. But those exotic pairs, they have super high volatility, meaning they can experience real sharp price changes, which can be very dangerous in a strategy. Because imagine you're just chilling in a trade, and then out of nowhere it spikes 50 pips in the opposite direction of where you want it to go and hit you out your stop loss. Then it goes back down and hits your quote unquote take profit that you did have. So you end up losing $100 rather than making the $500 just because of sporadic crazy changes in the price. So the high volatility can hurt you, but then there's other ones where you can experience very, very slow volatility, and it's just like, bruh, are you going to move? Is the chart going to move at all? So that's another thing you have to think about. So they also tend to have higher spreads as well. Like I've seen some have crazy spreads to where it's no point of trading it. Like for example, even right now, like Euro US dollar, the spread is high on Euro US dollar just from the time of the day it is right now. So if you see this line right here, this is the, I think the bid. Let me see. Let me make sure. I don't want to give you wrong information. Okay, so let me see. So 197, 7, blah, 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 29, 29. No, I gotta know this. Let me see. If my memory serves me right, let me just put let me see. Bear with me. Trading. Oh yeah, trading view is a staple. Definitely every trader needs it. I'm not gonna lie to you. They should have the bid and ask price on here. I'm trying to see. Am I reading? Maybe I'm trying to go too fast. Anyway, here it is. It's hidden. Okay, value line. Okay, so the bid and ask price isn't high right now. Okay, so as you can see, this is spread. So the bid and ask price. So if you're selling, it puts you into the ask price. Meaning, sorry. If you're selling, it puts you into the bid price. So it'll put you down here, and if you're buying, it'll put you to the ask price, and it'll put you up here. And then I said that wrong. It's the opposite. But I want to show you spread on some of these exotics. It's crazy. Where's an exotic at? Let me see. Let's see. Some of these spreads are crazy. Like, look at this spread right here. Look how fat this spread is. And there's been times where I've seen, so if I bought or whatever, it's going to put me all the way down here. And you don't want to be down there because when you buy, you want price to go up. And when you sell, you want price to go down. But there's times where I've seen the bid price down here and the ask price up here. So it's like the chart will have to move for days for you to make any money. So it's like, it's just not worth it. So personally, I stay away from exotics. I know some people that run up a lot of money on exotics. I honestly don't know how they do it, but they do it. And I'm not knocking anybody, but that's something I'm not going to do. So the bid price is the price at which buyers are willing to purchase a currency pair. So for example, if EURUSD has a bid of 1.18, it means buyers are willing to pay $1.18 for €1 in US dollars. So the ask price is the price sellers are asking for the currency pair. If the ask price is 1.18, then sellers want 1.1802 for €1. So that it makes sense. It's not too important when it comes to actually trading on the markets. It's just important to have that firm foundation. I can't repeat that enough. It's important to know this stuff. So then the spread is the difference between that bid and the ask price. So representing the broker's profit for felicitating the trade. So basically the brokers, they're making money on the bid and ask price. They're making money on the spread. So lower spreads are usually better for traders, obviously, because it's less trading costs, and it costs money to enter on those high spreads. But some brokers manipulate spreads, which you have to be careful for. They're usually unregulated offshore brokers, and they manipulate spreads so they can get more money per trade that you get in. So especially for those trading frequently on a tight budget, you have to be careful. But honestly, spread is not that expensive. It's not that crazy when you're trading at the right times, and it's not that crazy. I wouldn't worry about spread at all. Don't worry about it, for real. And so brokers, these are the companies or the platform that allow you to buy and sell. And you're going to be making a trading account with these brokers. I recommend 2 brokers that I personally trade my money with that has tens and tens and tens of thousands of dollars in it, right? And my philosophy on trading is you never have to put hundreds and hundreds and hundreds of thousands of dollars into a trading account. You can get funded hundreds of thousands of dollars, but I can't wait to go into that segment. We're not going to get in that segment yet. But so the brokers are companies or platforms that allow you to buy and sell the pairs or the instruments, because you can trade crypto, you can trade indices, you can trade commodities, you can trade, gas, energy, different energy instruments. So they provide the platform, the quote prices, and be able to execute the trades and then take money out of it, etc. So how do brokers make money? Because that's important. A lot of people don't understand how brokers make money. So how can I put my money in a platform and I make money on there and take it all out, and they make no money? Don't they have operating costs? Don't they have a staff? Don't they have developers, etc. like that? They make money. Trust me, they make a lot of money. So brokers, they make money primarily through the spread. They also have different fees and commissions they charge, overnight holdings for positions held overnight. So there's different kind of fees that they have, but it's not crazy fees. I'm telling you, you won't really notice. So they're really making money on large masses. That's why they like when a lot of people sign up for the broker. So they make more money when they have millions of signups. Because if you taking $1 from a million people a day, then it's like making $1 million a day just for felicitating and having a great platform. That's why it's important if you're a broker to have a great platform, because you want people to trade on your platform. You don't want anything looking janky or looking ghetto or cheap. And it's definitely essential to choose a reputable broker, because there's some schemers out there, but the ones I recommend, they're pretty safe, and there are competitive different spreads. So look for brokers that are regulated by financial authorities. Why is that like that? Look for brokers regulated by financial authorities like the FCA or the CFTC. And then if you're unsure about a broker and you still want to try them out, just don't put a lot of money into it. Like maybe put $1,000, a couple thousand, try them out, see if they're paying you out, then cool. Because not every broker is going to be regulated. Obviously, you want to be in a regulated broker, but sometimes the downside of a regulated broker is the low leverage. So you can't really risk what you want on a trade. So say example, you have a broker that's leveraged at 1 to 500, right? You enter that trade and you're able to risk 100 on this specific setup. But then you have a broker that's 1 to 50, and then they won't let you risk 100 on this setup, because it's quote unquote protecting you and wants to protect your capital. I'm like, bro, it's my money. I put this in here with the intent to make money from it. Let me trade it. So that's like the thing with U.S. regulated brokers. You got to be careful with, because of low leverage. It really does suck. So high leverage is nice. The quote unquote thing is they're trying to protect you, but I think it's really just regular. It's just trying to control you, to be honest. So just keep that in mind when choosing a broker. But I did recommend the ones that I do truly like and I do truly trust. So remember, we went over the major, the minor, exotic currency pairs. I trade major pairs. Sometimes I dibble and dabble in a minor, not really too much, and I never trade exotic. But that's again for you to see and soul search. I always say try out and soul search and see what is for you. See what's for you. I don't know what's for you. I don't know what's not for you, but see what's for you. And then let me know what currency pairs you guys have tried or are trying currently, because I want you to come back to this course, because I'll be responding to comments, but I want you to go leave this course, go to the charts, come back to the course, go through the videos, take notes, type things in the comments, ask questions in the comments. I'm here to help. I'm here to hold your hand for the most part. So you can ask me questions. I don't mind. So let me know what kind of pairs you have the best experiences with, or you want to trade. Um, so next segment is exciting. We'll be getting into understanding the sessions as far as Forex market hours and sessions and kill zones. I might not touch kill zones too much because that's a little too advanced, and I don't want to spam advanced concepts in this how to trade Forex. I want to keep it pretty simple and basic, but still build that strong foundation of a lot of knowledge that you will not see in any other course. So I will see you guys in the next segment. So welcome to the next segment where we get into Forex market hours and sessions, which is a very, very important topic. You should know this. You should know the best time to trade, when you shouldn't trade, and you should know the Forex market never sleeps, but not all hours are created equal. It doesn't sleep, but not all hours are created equal. Not all hours, not every single hour will give you the best bang for your buck. It's levels to this, kid. So this basically, you have to know when a trading session opens and closes. It's crucial because different sessions bring a unique level of activity, liquidity, and volatility, bro. I want you to say right now, volatility 5 times as fast as you can. Volatility, 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 volatility. Okay, I kind of did it low key, but it be tongue twisting my butt sometimes. I ain't gonna lie to you. Pause. So each of these sessions, it has its own trading behavior and characteristics. For example, trading during a high liquidity session, it often means lower spreads, as we talked about before. And then when you want to trade in lower liquidity sessions, the spreads are higher. You get into trades lower, but the opposite, you get in faster on the high liquidity. So it can offer more stability in those lower frequency trading sessions or volatility trading sessions. Like Asian session, for example, is very slow, it's very quiet, but you can get some plays and it'll go the way you want it to go. Well, it'll go the way the charts want to go, but the way you predict and expect. So you know how you have the accumulate. I ain't about to give y'all too much of the advanced sauce because it's going to confuse. It's going to rattle the brain a little bit. So we're going to go slow with it. So there are 4 major sessions when it comes to the Forex market and when it comes to the charts. So you have Sydney sessions, right? I don't pay attention to that much. I've never really heard of a Sydney session, too much of anybody talking about it. My main thing is Asian session, London session, and the New York session. But we're going to break each of these sessions down. So first things first, we're going to go over a Sydney session. We're going to go over the time, right? We're going to go over the volatility of it. And if you think this is something you want to trade, its best uses, its pros and cons to it. So let's get into the session. So the Sydney session, the hours and characteristics. So it opens around 10 p.m., right? Where the market's open, quote unquote banks. It's like the time of the day. It's like waking up, everybody wakes up. So Forex is open 24/5, right? But there's different parts of the world where it's open because of different currencies. So it's kind of like different parts of the different banks opening around the world. Kind of think of it like that. So Sydney, the sessions opens at 10 p.m. and it closes around 7 a.m. So during that close, you have to understand it's more so where the chart is moving a bit less because it's closed and not a lot of actions going on. So that's when you think about when it closes, right? But that's just for Sydney session. That's not really a crazy volatility session. So generally the Sydney session is super quiet. It's less volatile compared to the other ones. And since larger global markets aren't as active, there's way less trading volume. So it's definitely less sharp price movements, which can be a good thing, but also be a horrible thing because you're not really getting any movement in charts, meaning you're not really making any money. So because it's lower paced, it's ideal for more traders that analyze like recent trends, probably going to hold for a couple days, not really into scalping or short term or day trading, more so long trading, short term trading. And so the plan, your strategies we use for upcoming will be way more slower. You definitely would not use this for super active sessions in this session, the Sydney session. And it's good for beginners of practice, I guess. I'm not even gonna say that. It's good for beginners to practice if you want to trade like that, but it doesn't make sense to practice something that you're not gonna do. I always say practice how you play. Trade exactly how you're in the Fake markets trade exactly how you would trade in a live market. So now we're gonna go to the Tokyo session, right? The Asian session, right? So it overlaps. All the sessions do overlap a little bit, but this one overlaps briefly with the Sydney session opening at 12 a.m. GMT and closing at 9 a.m. GMT. So this is like the financial hub for Asia. People call it the Asian session, right? I never call it the Tokyo session. I call it the Asian session. I'm just giving you the technicalities and the right terms for things so you can have that strong foundation. So this brings, it's definitely more activity. It's not as crazy as New York or London, but during the Tokyo sessions, the pairs moving are like USD JPY, you know, the Japanese yen, because it's Japan, it's Asian. So you got your Euro JPY. It might experience more price movements due to higher liquidity in the Asian market. So you could definitely take some wins. And this is great for people that work a 9 to 5 job. Why? Because they get the moving at 8 p.m., 9 p.m. So it's going to be harder for you to trade New York, but it'll definitely be easier for the trade Tokyo session. It is a little more quieter, but you definitely will be able to catch some moves, capitalize some things on the market. So that's a great thing for Tokyo session. Then we have London session, which is a staple in my trading journey, because I remember waking up when I first dropped out of college. I was working at my mom's. I was not working at my mom's house. I was living with my mom, but I worked a warehouse job, and I had to be at work in the mornings or even the evenings and daytime. But every night I would wake up around 2 a.m. to get on London session and trade with the bros, because they swore up and down they had the best bias. They had the best strategy for London. So we would get on there, either win or lose. It was like, it's funny because it's just a great part of my trading journey. And I'm the only one that stuck with it and really built the life that I am enjoying, that I love. And it's just an interesting story, man. Just an interesting story. Anyways, back to the information. So the hours for London, it's like 7 a.m. GMT, and then closes at 4 p.m. GMT. So GMT, we're going to go to GMT. So it's not like I'm talking from EST or PST. You know, it's GMT. That's what the charts are on, GMT. You can always change it, though. It's GMT plus 2, GMT. It has a whole bunch of different times, but translate that to GMT. So 7 a.m. GMT to 4 p.m. GMT, that's like, what, 12 a.m. to 5 a.m. EST, if I'm right. I gotta look at that. I'm gonna let you know. So high liquidity and volatility. That's why I told you London, it gets jumping at night. Before I go to sleep, it gets jumping at London. So like your major pairs will be moving: Euro USD, GBPSD, USD Chef. You'll definitely see higher validity in the European markets and trades, just because you have your Euro, your Great Britain. We're asleep. Well, you should be sleeping unless you're a night owl. But yeah, so those are best for major pair trading and nice, quick little scalps. And when I say scalp, I'm not talking about in a trade for 5 seconds. I'm saying like, 10, 20, 15 minutes. Definitely some great moves, some great movement. So I do enjoy London. I don't trade London because I don't need to. Another thing, you don't need to be trading every single session. You have to think, why would you want to trade every session? One session can pay you. So there's no point of trading every single session. Trade a few different sessions, see what sessions work for you, see what sessions work with your personality, see what sessions work with your schedule and your life, your family. Just kind of see what works for you. And so we have New York, which is my favorite. I trade New York in the morning. It opens up about 8, I think. So the New York session is 12 p.m. GMT and closes at 9 p.m. GMT. Let me actually look up really quickly GMT to EST. So, Greenwich. I didn't know that. Greenwich. See, I'm learning with you guys. It's Greenwich. Greenwich mean time. Wow. That's interesting. That's very, very interesting. Okay, so GMT. I'm going to get this for you right now. So, New York is 12 p.m. GMT to 9 p.m. GMT. So, 12 p.m. Okay, 7 a.m. So I was right. I said 8 a.m. Sorry. But the thing is, there are kill zones. It is an advanced concept. Kill zones is an advanced concept. I'm not going to go too much into the advanced right now. That's way out of this course. So kill zones is the specific hours that you need to be trading in these sessions. So the sessions can be 8 to 9 hours, 12 hours long, right? But the kill zones get you down to 1 to 2 hours, 1 to 3 hours. In that time frame, that's where you want to execute that trade. Sometimes even 1 hour. In between this 1 hour, that's when you want to execute that trade. So kill zones can be advanced, and it's definitely great to know. So New York, high volatility, high liquidity. That's when everything comes out. That's when a lot of the news, economic news, comes out, which can really make the charts move. And I enjoy it a lot. So pairs involving USD, your USD, GBP, USD, JPY, they have the most activity usually during this time of the day. And so when the market is most active is usually during session overlap. So you can kind of relate that to the kill zones, but it goes a little more in depth. But it's definitely volatile when those different news comes out, and news comes out. It's not like random, like, oh, a bombing happened, this happened, oh, this and that. It's more so announcements, payroll, economic news that like comes out regularly that we're expecting, that you can see. So you'll know news before it is announced or before it comes out, just from different websites that I'll share with you. I'm gonna, in the description, I'll have all the resources you need to get on your way into trading. And so you have to consider your different trading style when it comes to the different sessions, whether you're a scalper, you're a day trader, you're a swing trader, with your personal schedule and how you want to do it. You know, like I said, it's not one size fits all. It's definitely geared towards you, and you have to do a lot of soul searching and see what works for you through trying. You have to try different things. So remember, we have the Sydney session, we have the Tokyo session, we have the London session, and we have the New York session. Me personally, I'm trading on the New York session because it works best with my schedule. Since this is my full-time job, I don't have to worry about trying to catch New York session because I'm at work. But since it's my full-time job, this is quote unquote my work, right? So hey, remember, it's all personal preference. It's all up to you. So let me know actually in the comments, like, what your experience is, what your schedule is, what session will probably work for you, or questions you have about the sessions and what you can do to better those sessions. Yeah, I'm excited for the next video. We're going to get into pips, we're going to get into lots, and we're going to get into leverage. And this is key to knowing how much you want to risk on a specific trade. So I'll see you guys in the next video. Hey guys, so I know it might seem like a little weird jump of sceneries, but this video was corrupted, so I'm going to be redoing this video where we're going to be introducing you to pips, lots, and leverage. I like that, pips, lots, and leverage. So in Forex, it's the small movements, they can lead to big gains or losses, but how do we measure these movements? We measure them by pips. Pips, what does a pip mean? What does a pip mean? I've always heard of what a pip but what does it actually mean? It's a percentage in point. It's the smallest measurable movement of price in a currency pair. So for some currency pairs, or actually most, 1 pip is typically equal to the movement of a 4th decimal place. So like for USD JPY, a pip is measured in the 2nd decimal place, so 0.01. But for Euro USD, it moves from 1.1000 to 1.1001. So that's considered 1 pip. And so actually on TradingView, it has a measuring tool where you can measure the pips. So you can click anywhere, scroll up, and as you see right here on the right side, it is 20.8 pips, and this is USD JPY. So you can literally, it's 0.35. Yeah, 0.35. You can add plus 20.8 equals 153.562. So that's 20 pips. So what if you just target it for 20 freaking pips a day? That could literally change your life. Or if when we look at another example like Euro USD, when we measure the pips, and pips is how you actually calculate your lot size. So we draw from right here to right here. That's 16 pips. What if you just want at 16 pips a day? 16 pips a day and you're done. So as you can see from the decimal places is 0.3, right? Or 3 decimal spots. Yeah, 3 decimal spots. So if it moved from 369 to 518, you would just add 36 to 51, and then you'll add 36 to 16, and it'll get you that 65, around that 65. So it's very simple, but you don't even need to know the calculation. It's like so many resources now and tools. It's like to measure it the old way is just pointless. Like, bruh, boom, boom, boom. You can measure it up, down, up, down. I love how it changes colors, or negative, positive. So for instance, say we wanted to get into a trade, right? you would click right here, and you wanted to figure out your lot. So basically, with your lot size in a trade, right? I'm gonna show you how to calculate your risk. But a lot size, it's a standardized unit size for trading currency, and it allows traders to control the position with ease. So basically, you know exactly how much you're going to be risking on each trading. You know exactly how much you're going to be making on every single trade that you take. So, for instance, a standard lot, this is like 100 units of currency, like a roughly equivalent to a $10 gain or loss. And then you have a mini lot that's like 10,000 units and it's worth about $1. Then you have micro lot, which is 1,000 units, worth about 10 cents. So the importance of lot size is knowing that you can use that to calculate your risk, and it's how much you're selling or how much you're buying. So I'm going to show you. We are going to measure right here to right here. That is 15 lots, right? And we're going to be entering a buy position, meaning we're expecting price to go up. So from right here to right here, how many pips is that? This is 17 pips. So where do we go? We go to our position size calculator at my FX book, and we insert Euro USD. No, thank you. We enter Euro USD. You just type it in. I think we said 16, right? So we have a, I don't know what. This don't really matter. Say we want to do swap with money and we want to risk $100 on this trade. Our stop loss is about 16, and trade size loss, you can keep that same. So calculate. We be dropping a 0.06. So we go to Sway. We go to Euro USD. And then we be dropping a 0.06 buy. And then we drag our stop loss to the same spot, which is like a little below this low. When we drag it down about right here, let me make sure the same time frame. So that's 5 minute, down a little below this low. Yeah, and so we should be, when we look at our stop loss, it should show about $100 loss. Let me make sure it's on the right. Oh, this is 5 minute. That's why. I mean, this is 1 minute. Sorry. So 1 minute. This is actually still looks a little off, right? Let's see. Okay, so it is $100 loss, but because Sway is a little off with this, it will be 1 decimal over. So you actually make this 10, then you would calculate it. Stop loss pips, bro. What the heck? I did not. Okay, so actually it's not off. That was an error on my part. I put 166 pips rather than 16 pips. So let me do that example again. Messing up the motion. So it would be 0.68. It had us do what? 0.68 pips. So you see, we put 16 pips and then it gave us 0.63 actually. So 0.63. So we buy, drag our stop loss down here, and now it should be at 100. Yeah, so $101 will loss. So that's basically how you calculate your lot size. Just make sure you actually put in the correct values. Obviously, it's easy to put in the wrong values, as you see that I just did. So that could really hurt you on a trade, because you might think you're risking $100 on your trade, and then the whole time you're risking $1,000, and you can mess around and accidentally blow your account just from small errors like that. But okay, so now we move into leverage. So leverage allows you to control larger positions with a smaller amount of money. So for instance, with a 100 to 1 or 1 to 100 leverage, you can use more money and you're able to risk more money. Some regulated brokers like Forex.com, they only allow you to do what, a 1 to 50. You can barely risk $100 on a single trade. If you have like a $10,000 account, you can they barely let you risk $500 on their thing. So that's very trash. So the larger leverage is on your broker, the more you'll be able to risk on your trade. It's kind of weird how they regulate it, but 1 to 500 or 1 to 100 is more than enough. It's just 1 to 50. It kind of makes it harder. So basically, if the position gains 1% of value, you make 1,000 in that profit. If you had a $100,000 leverage, right? So that 1 to 100, say you have a $1,000 account, right? You have 100 to 1 leverage. You're basically controlling $100,000 position. So basically, people that were rich were only really allowed to trade Forex until the brokers and all that made it possible for regular people to be able to trade the market. So, but I want you to understand, if you have $10,000 in your account, you have $10,000 in your account. Whatever you risk, that's what you lose, and whatever you make, that's what you make. Don't really get too much in the too deep into the leverage. It's not really that important. Just know you can risk what you risk and you can't what you can't. So, but it allows you to be able to make those larger positions basically in the market that you normally wouldn't be able to make if you didn't have that. But you need a broker to be able to trade. So it's just an automated thing that happens. So pips, remember, as a center unit for measuring currency, use pips to measure the movements. Pips measures the movements. Lots to define the position size, influencing your profit or loss per pip. So you lost your lots go inside that bar, and you know exactly how much you're buying or selling, and you know where your stop loss can be and where your take profit can be, so you know how much you're losing as well as you know how much you're making. And then leverage is just a tool that increases both potential profit and risk. So remember, next video we will be introducing risk and basic chart technical analysis, as well as diving a little bit deep into news. So again, this was a corrupted video before, but now we cleaned it all up. Lots, pips, all that. I want you to go back. I want you to test a couple trades. I want you to go into the charts, calculate a couple stop losses, etc. See, make sure you're doing it right. And if you have any questions, make sure you put them in the comments below. So welcome, where we can finally start talking about charts, get on the charts, mark some stuff up, actually explain the candles, how things move, why they move. You're going to get just a little bit of my advanced and probably obsolete different perspective on the charts and why it makes me so profitable and why I can exploit them more than your average Joe. So first things first, I know it looks really complex, but there's a roadmap to making these smart trades, and we're going to dive all into it. But the purpose of the video, we're going to be introducing the candlesticks, going over basic patterns and the concepts of your so-called support and resistance. I'm going to kind of explain, give it just a little bit of advanced concepts on that in particular, because you might be thinking support and resistance as something you already know or how it really works, but I'm going to tell you how it doesn't work. And then we're also going to be going over the foundation of technical analysis. So first things first, what are candlesticks? So first of all, candlesticks are just a representation of where price has already been, where price has already left, and where price already went. So all it is it's explaining the time, right? So when you look at the time frame, let me make sure you can see everything on my screen. So up here, if you look, these are different time frames, right? So on the time frame, it represents a candle. So we're on the 5-minute time frame, right? So each candle represents 5 minutes, right? 5 minutes of price action is each candle. If I go to the 3-minute time frame, you see how it changes? This is still the same chart of USD, JPY. Remember when we talked about pairs, currency pairs, or quote unquote instruments? Each of these candlesticks represent 3 minutes of price action. Then we go to the 1 minute. Each of these candles represent 1 minute of price action. So once 1 minute is over, it starts and it begins a new candle. And then we'll go as high as you can even do 12 months, right? Each of these candles represents 1 year of price action. It's actually interesting. I never really jumped back to the 12-month time frame. But as you can see, we go, dang, wow, all the way up here. Anyways, in 1971, so that's the record they got. I guess they only go back, is that 50 years? So go back about 50 years, right? So that's just explaining to you what each candle really represents. So let's get into it. On the candles, let me get rid of these bid and ask prices. I never keep those on. I always keep them hidden. Also, if you see me looking over, I'm just referring to my notes so I don't lose track and keep everything structured. So me personally, my down candles are black. A lot of times you'll see red and green candles on your chart. I kind of believe, and I was actually taught just a little bit, that when you change the colors of your candles, it can kind of take away the negative emotions, as well as it can take away that desire to have a bias in one direction, one way. Because usually people see green candles, they always only want to buy and look for buy setups. But me, my charts are very neutral colored, so I'm looking for sell and I'm looking for buy setups. So I keep mine blue and keep mine black. So my black candles are down candles, meaning price is going down. My blue candles are bullish candles, meaning price is going up. So we're gonna break down the entire candle and what it means and how it works. So the bottom of an up candle right here. Actually, let me cut this off so that we can get a still candle. So we're looking at this black down candle, right? Right here at the top of a down candle. We're not talking about the wick. The wick is a little spike that comes up. That's where price has been, what would we say? So this is the open, past the open, and it end up coming down to be a bearish candle. We're talking about the body of the candle. The body of the candle is the fat junk in between the wicks. That is the body of the candle, right? It's from price open to price close. That's the body of the candle. Price open, price close. And what do I mean price open? Price open when that new minute starts, or that new hour starts, or the new 5 minute. But in particular, we're going to be talking about the 1 minute because I'm on the 1 minute time frame. So it's when the 1 minute opens and when the 1 minute closes, right? So I'm going to write it down for you. Open, close. This is open, close. And then we're going to do, also going to do the body of the candle. That's the body of the candle, right? Body of the candle. And then we're going to look at the wick of the candle, which is the little wick that comes out. You know, we call these candlesticks. So this is the wick of the candle. All it is showing you where price was before it closed. So the bottom of a wick on a bearish candle, this is bearish specifically, meaning a down candle. It's the wick is where price was before it closed, and on top it's where it was before it or after it opened. So wick of candle. And you don't know if a candle is completely, you don't 100% know if a candle is going to be a bearish candle or a bullish candle until it closes, because that's where you have long wicks. So even when you see a trade play out, you can have a long wick right here. Like, for example, at one point price came, it opened up, right? Remember, the top of a bearish candle is open. So it opened up right here and price went all the way right here. So at one point, this candle, it was all the way solid. So it being all the way solid means it was a bullish candle at one point. So make sure you take notes, screenshot this, take a picture. Now we're going to move to a bullish candle. So a bullish candle, the bottom of the wick, you see the wick? You see the wick? So for a bullish candle, the bottom of the body is the open. That's where it starts. And the top is where it closed. It's very simple. It's just opposite because, you know, up and down. It's just opposite. It's very, very simple. And we call these doji candles where it's very indecisive. When it doesn't really have a body, the charts are kind of indecisive on, quote unquote, where it wants to go. But me, it's really telling me that it's setting up for a change in direction for in as far as the candles. And there's very different patterns that you can use. Me, I'm not too much into pattern trading, more so I'm into actual price action, so I'm not even going to confuse you with that mess and start that. But we will get into support and resistance, where we talk about where price is rejecting off candles. But I'm going to tell you where it's an inducement of liquidity, where price wants to take out, and that's a very advanced. It can get really, really advanced, but I'm going to give you the basics of it and how price works. So price, it's all driven by money and it's all driven by liquidity. It's not pattern based. It's not news operated. It's all algorithmic and it's all money. It's all about taking the money. So price is always going to go to the relative lows, relative equal highs. So these are relatively equal to each other, right? We got relative equal lows. People will call this a support line, where price is supported on this line. But price doesn't care nothing about this imaginary line that you're placing on it. Price knows that you're going to be placing your stop losses. What is your stop losses? It protects your money, so you know when it hits that stop loss, it's going to take you out the trade, so you don't lose your whole entire account. You're only going to lose just maybe a percentage of your account. So it comes and take these stop losses. That's why a lot of people's stop losses are underneath these lows, because they believe it is strong support. But me knowing what I know price is going to come and take those stop losses to take you out the trade, to liquidate your money, because it is liquidity residing below here. It is money residing below at the bottom of those relative lows. People will call that support. I call it money. So price is going to come down, is going to take these lows out, come back up, and keep going down to keep taking more lows. People call it support. I don't. I call it money. And then it's literally vice versa with resistance. So people say it's resistance, so it won't pretty much go higher. They will call this resistance. Price came, tested resistance once, it came back, tested it again. It's not going to come back and pass this resistance because it's a strong level of resistance. But no, all this did was induce liquidity, meaning it induced more money, it induced more stops above this high. So what's going to happen? Price is going to come up. It's going to take these highs and it's going to push back down and go into where it wants to go. So you can still even be right in a trade and still lose money if you don't know these simple things. And this can get so advanced and so complicated, but we're going to leave it right there. So now you do understand how the markets move. They move based on money and liquidity and liquidity inducement. And you understand how candles work and what candles are. So, candlesticks are, it's a very, very, very simple concept. It's just the body and it's just the wicks. It's very, very simple. And inducement of liquidity, it can get really advanced, but I gave you enough of the basics where you can kind of go on the charts, kind of see, okay, this low was taken out. What did price do after this low was taken out? Or more so, what did price do once these relative equal highs or these relative equal lows was taken out? So we have, you see, we have relative equal highs, right? I mean, relative equal lows right here. Two lows that are relatively equal to each other. What did price do? It came and even created another inducement of liquidity. So now we have three relative equal highs. What is price going to do once it comes all the way up here? It's going to take liquidity and it's going to want to go down, take this liquidity. And it needs liquidity to move. Price needs to take out these highs and these lows to move. So it's very, very simple concept. That's basically what you would do. And how you get your bias and really do your technical analysis, you want to look at multiple time frames. So if I'm entering a trade on the 1 minute time frame, if I want to look for a 1 minute setup, a 1 minute entry, right? I might start off on the 15-minute time frame to kind of see, okay, what liquidity needs to be taken out, where is price going, and why is price wanting to go there. And you know, you get more of the advanced concept later on outside of this course. But it's important to know, ask yourself those questions we can get on the chart. Okay, why is it doing this? Why does it want to go there? And then, you know, just try to think liquidity. For now, in the beginning of your journey, try to think liquidity, right? And what liquidity does it want to take out? What relative equal highs? What relative equal lows? So once you see that on a little higher time frame, like the 15-minute, you look for the 1 minute where it's a good place to enter a trade in, right? And that could be the 50% of a range. Like if you do a fib, it could be 50% of a range where price wants to balance itself out, which can be a really advanced concept. We're not going to get too much into that stuff. But once it gets to 50% of range, it came to 50% of range. What happens? It starts rejecting, and this is live right now. So that's very, very simple concept. I'll see you guys in the next segment where we really head hard onto the introduction to fundamental analysis. We're going to be, you know, going over like news releases, a few indicators, and kind of central bank decisions. I do want to talk heavy on news, just kind of explaining everything. But that is this video. So I'll see you in the next one. Welcome to this video. We'll be talking about news, a little bit of kind of understanding and reading news. Me personally, I don't read news too much. I just make sure I'm aware of the news because I don't trade news. I don't really see a point of me trading news. I make enough money when I don't trade news. You can try to capitalize on news, but all it does is make things sporadic and it can make it way more volatile. So like even when you see people trading news, for example, where's some news like right here? Let me get rid of this from the last video. For example, 1 second. Right here, right? See these sporadic movements on the 1 minute time frame, which are crazy huge. This is most likely a news event that came out, right? A news event where somebody said something, or they came out with a non-farm payroll, economic news, or something like that, unemployment rates. So you can see here, right? You can go to forexfactory.com and it can tell you everything behind the news. So a high impact expected. Red folders is what I stay away from. Orange folders and yellow folders, I welcome them because it can just, you know, induce a little more volatility and volume in the charts, make it move a little faster, make my price, make my targets get hit a little quicker. But personally, I'm not into trading them. So for example, you can go and read the news. So it'll even break it down and explain it to you. So actual lesson forecast is good for currency. So if it's good for CAD, that means if CAD is on the left side of that slash in the currency pair, it'll go up, right? Or if it's not, then it'll go down. Does that make sense? So it's relative to each other. So it'll tell you if it's good for the currency or if it's bad for the currency of what happens. But the thing is, it tells you after. Well, you know what it is, but like, you know, if it's actual greater than the forecast, is it good? But you have to guess before the news comes out if it's going to be greater or is it going to be less. and you have to guess the news, right? I'm not into guessing the news. I'm into market structure. I'm into price action. I'm into institutional order flow and how the charts actually move. I'm not really into reading the news, etc. like that. So I'm not going to be teaching something that I'm not into or something that I don't recommend. I recommend learning the price action, learning how the charts actually move, and understanding that all news does is just speeding up the process of what was already going to happen. News is speeding up the process of what's already going to happen. So for instance, like when we talk about news, it's just driven factors, right? What else do I want to go over in the news aspect part of this? Because news, it can be complicated, but it's not really. So there's a lot of indicators for news. I don't use indicators. The only indicators I use is like the Fibonacci tool, right? And that's to see the different levels of price. So I know charts have to always be balanced. My 0.5 is the fair value. So I only take buys below the 50%. Meaning I only take buys in this square, and I only take sells in this square above the 50%. And it depends if I'm looking for a buy or sell setup. So if I'm looking for a buy setup, I'm thinking, take buy. So I would buy right here and write it up here. But if I'm looking for sells, then I would draw this differently. So it would look like this if I'm looking for sells. And so what happens? I take a sell above the 50%. Is this in above 50%? You see that? Above the 50%, I'm taking my sells. So that's what I do, and it will help you, and it will increase your win rate dramatically just by doing this. And so when you understand the market sensitivity to news, you'll know not to trade that red folder. Or if you want to, some people make a lot of money trading red folders. Why? Because you'll buy and instantly shoots up. But some people lose a lot of money trading red folders because you'll sell and it can instantly go up and you can blow your entire account. Because when you're trading a live account, just because you have your stop loss there, if price goes crazy like that, it doesn't automatically mean it's going to fill you at that point. You have to know and be aware of news, that news is like that, and news can get really, really crazy. That's why it's important to be careful when you're trading news. Please, 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 please be careful. Be careful when you're trading news. But so even when it comes to like I don't want to talk about that. But I'll kind of go over some of the news because you'll see it and you'll be like, okay, what is this? I'll go down the list of them. So you have your GDP, you have the CPI. I wish some of them would show here, but none of them. So see, like for example, you have CPI, right? I'm going to explain all of those so you just know what it is. Unemployment rates, you have interest rates, and that's it. That's the main, usually, market sensitivity news. Oh, yeah. Non-foreign payroll, foreign payroll, that's crazy. Interest rate announcements, inflation reports, and I'm going to explain those. So, basically, GDP, it's, how do I explain this simply? A strong GDP growth can signal the strengthening currency, right? Or you can think of a GDP as the pulse of a country's economic performance and how their economy is doing. So GDP, it lets you know how their economy doing. So if US dollars economy is doing bad, then anything cross with USD. If USD is doing bad on USD JPY, then the chart is what is likely to go up if USD is doing bad. Because in Japanese yen, if it's staying stable and USD is doing bad, then JPY is going to go up. So inflation rates is just and the rising of inflation, or if inflation is going down, and we use that for CPI. That's what CPI is. And then employment rates is pretty obvious in its name. It's just indicating stable economy. And remember, all these things have to do with money. We have interest rates. But me, like I said, I don't pay attention too much reading into all the folders and whatnot. I strictly look at price action, market action. I'm not watching the news, looking at Powell or somebody speak. That's the head of whatever department or whatever economic entity. I'm not waiting for them to speak, seeing what they say. I look at what is the charts giving me, where does the charts want to go, what liquidity is there, what's that, what high was broken with that. You feel me? That's what I look at. And then in the morning, before I get in a trade, I will go to Forex.com. Why? Not to look at the folders, not to read the folders, not to see what's inside the folders, but to see at what time is there going to be a red folder. Is it going to be a red folder at the time that I want to trade during this kill zone? Then I'm probably going to wait until after the news, because I'll still trade after news, but I'm not going to trade the news. I know this is a quick video, quick segment, but it's just about the news. So we're going to get into one of the most important aspects of trading, which is risk management. In the next video, we'll be going over stop loss, take profit, break even, partials, all the good stuff. So that's going to be a little longer video just because how important it is and how deep it goes and how basic it really is, which a lot of people don't have that basic understanding of risk management and how it works and how consistency works with your risk management. But I'm going to go into detail on that. So I'm excited for that video. So I'll see you in the next segment. Welcome to the next segment. In this video, we'll be going over risk management, which is vital in your trading journey. We're not just chasing profits, we're risk managers as well. So it's like you have to understand when you first start trading, it's not really about making a lot of money, right? The true goal when you first start trading, it's about keeping the money that you do have. It's about not losing money. That's the beginning. When you're first starting your Forex journey, it is about not losing your money, being able to keep as much money as you can, trying to be more break even rather than draw down. Then as you get used to that, then that's when you really start to focus on making exponential growth on whatever account size you have. So risk management is basically managing the risk of your account and how much money you're going to be putting into a trade so your account can stay a certain amount over, not even a certain amount over, but just be able to protect your funds because it's your money. You worked hard for the money. It's not like money's just dropping out of the air. You go and you spend time, you're spending hours, essentially a part of your life for this money. So the money is important. So for example, say you have, let's do black so it'll be easy to see. And I am drawing behind. Let's just start doing. We'll start right here. So say you a realistic trading account where you can trade full time and have a full-time earning that is maybe $5,000, right? And we're going to make this black just so you guys can see it easier on charts. We have a $5,000 trading account, correct? It is wise. It is wise to spend around, when you're trading live, it's different. So if you're trading a prop firm fund, so basically you pay for a prop firm, they give you access to money once you show yourself profitable, making a certain percentage, whether it be 10% over 2 weeks or 5% over a month. You show yourself profitable, then they give you money to trade with, right? But say you want to start with live accounts. So say you've been trading for a while on demo, you've been making money, and you want to start a live account. So if you have a live account, say you've been doing this for a while, you want to put $5,000 into a live trading account. You would be risking 5% per trade. So what is 5% of $5,000? We got $5,000. They updated iPhone. We have $5,000. That is $250. You will be risking $250 per trade. This way, you can lose a lot of trades before you lose your entire account, if that was the case. And so how I do my risk management is I do the percentage of the initial balance put into the account. So obviously when you lose money, that percentage, that 5% will get smaller and smaller as you're losing money. But I will stick to the $250 of the initial account. That's just how I like to do it. You don't have to do it like that. But it's important to have a risk management strategy in place, right? And we're going to go deep into this and I'm going to explain it very, very well. So you're risking $250. You risk $250 per trade. And your risk reward ratio does play into your risk because say on average, you take a trade of 1 to 3, but you have a 50% win rate, right? So meaning you win 50% of your trades, which also means you win 5 trades for every 10 trades you take. So if you're doing a 1 to 3, correct? So 1 to 3, that means every $250 I risk on my wins, which we'll put W, I win $750 because 350 times 3 is 750. So you win $750 on your 1 to 3. When you lose, we'll put L. On your 1 to 3, when you lose, we'll put L. You lose $250, right? So if you're going to be winning $750 per win and you're losing $250, right? And you have a win rate of 50%, which isn't bad starting off. So you win 5 trades every 10. So that means, say you win 5 trades, right? 750 times 5. $3,750. $750. And you lose 50%, so that's 250 times 5. Lose 1,250. So 3,750. What is that? I think it's like 2,500 maybe. Minus 1,250. That's $25 profit, right? This sounds good and it sounds simple and it sounds so clear cut, but what you have to understand is nobody is telling you how many trades you're going to lose in the row before you hit your win streak. Because there's been time where I've had losing streaks in my win rate and in my trading experience. And if I would have continued the revenge trade and up my risk, I would be hurt and I would get my account jacked up. So nobody really tells you that you could lose those 5 trades in a row first. And so you lose those 5 trades in a row first. What, you're down $3,750. Now you're looking like, dang, my account's down. I have to risk more to make that money back. That's what we call revenge trading. You do not want to revenge trade, meaning after you lose, you go back on the charts and you risk more and then you're salty. You have to allow yourself space to lose, right? So me personally, say I take 3 trades in a day. I might risk my normal $250. Right, on this $5,000 account. Say I lose that trade, so now I'm down $250 for the day. I will cut my risk in half on that next trade, meaning I will risk $125 on the next trade. Meaning I will have to win a 1 or 2 to make my money back. But hey, we're still break even when we want our money. And say I do lose, I'm only losing $125. So the next day, if I win the $250 trade, which will be like a 1 or 2, I'll make all that money back I lost yesterday. That's why it's important to keep strict risk management. So you can limit yourself. So your risk management plan could go into how many trades you take per day, how much you're going to risk per trade. I want you to write this down. How many trades you're going to take a day, how much money you're going to risk per trade, what percentage per trade you're going to risk, what is your win rate, what is your risk reward ratio that you go after, right? And what will you do in the case that you lose a trade? What is your plan for that? And what is your plan for when your account hits below 50%? So these are all the things you need to think in your risk management strategy and why it's so important. And so it's important to have a winning win rate that's over. Well, it's important to have a great risk reward ratio. Don't settle for anything less than a 1 or 2. I do not recommend that at all. And the importance of a stop loss, right? You can be right and be wrong. It's obviously so important to know where you place your stop loss. You know the general idea of you're placing it below highs, below lows, you're placing it, above highs or below lows, depending if you're in a buy or a sell setup. Obviously, we know that by now, hopefully in the course, when you buy, say we place a buy right here, you want chart to go up, you make money. Say we place a sell right here. Say we place a sell up here. You want price to go down, you make money. If you place a sell and price goes up, you lose money. If you place a buy and price goes down, you lose money. So you can make money both ways on a chart. So it is, what is the word? It is recession proof, right? So, where was I? With the stop losses, it is so important to calculate your stop loss. And this is where we get into when we bring back the pips we talked about, to know what size you need to be putting in your lot and then going to your stop loss. So, for instance, say we want to put our stop loss. I'm going to rewind time. Say we want to enter into a buy right here. Boom, right? And we want our take profit up here. So you're not entering the trades on TradingView. They're just for analysis. You're going to be wanting to enter your trades on your platform, whether it be Sway or Osprey, which I'll link you guys. So this is a demo account right here. So say we do Euro USD, right? Let me reload this page, tweaking. And actually, we'll even do a live example. That way you guys can actually see. So say we want to place a buy right here, right? So say we want to buy, place our stop loss below here, and say we want to risk $250, correct? So we'll measure, and we're on USDJPY. We'll measure the entry to the stop loss. What is that? That's around 14, 15 pips. So you go here, you pick your, you just type it in, JPY. You can put your account size, say it was $5,000 account size, and we want to risk, what, 5% of our money. and then we will put 15 pips, and then we will calculate, and then we will be placing a 2.55 lot size. So we go to USD JPY, and if you're on lower time frame, you obviously have to move faster because the charts will move and things will change. So 2.55, right? Buy. We're gonna we're gonna place our stop loss below here, and it should say around $250. Oh, let me put a stop loss. So 152.595. You can also place it in here. So it's about $238, $250. It's not gonna always be like obviously exact because the numbers are moving. So that's how you calculate your lot size, and it's very, 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 very useful tool. You should be calculating your lot size every single trade, so you know exactly how much you're going to lose in the trade. In the beginning of my trading journey, I would just full margin, meaning I would just buy as open as many orders as I could, just to let the trade run and to make as much money as I could. I didn't even use a stop loss, and that hurt me bad because if you don't use a stop loss, you can lose all your money. Remember, it's important. You want to keep your money. You have to focus on managing your risk rather than just chasing all the profits. It will help you in the long term because you have to understand trading is a long-term, long sum numbers game. It is long term. It's not about the short wins, not about the good days, it's not about the good weeks. It's about the good months. Can you have the good months where you manage your risk, you follow your trading plan, and can you not be so salty and be upset when you're trading, when you lose a trade? Because you have to understand, in the beginning, I want you to trade demo, right? Maybe 1 to 2, 3 weeks, just so you understand the concepts, whatever concepts you're practicing, know how to enter a trade, know how to get out of a trade, know how to manage a trade, which I'm about to show you in a second. And then you want to open a live account. Why? Because when you open a live account with the real money that you worked for, the real money that you spent time at your job, wherever you're doing to make money that you work for, it's at risk. You get it's a different wave of emotions that come into play. So now you have emotions that you are dealing with. And as you can see on the charts, we're up money because we bought, but we're up what, $20? So that's cool. That's kind of how the charts work. So you have to understand that where was I with the risk management? Oh yeah, the emotions come into play when you're trading real money. So you might be making different decisions. You might be making, that's why I say don't trade demo long, because you don't get the full effect of what trading is. You might be revenge trading, you might be forcing trades, you might be seeing things that aren't there, etc., etc., etc. So that's why it's so important to not demo trade too long and focus on managing your risk, because you have to understand it is a long-term, long-sum game. It truly is. But I do want to go into managing your position. So say for instance, it's kind of hard to manage your position when you're in drawdown, but say let's close this. I'm going to try to buy and get us into a profit. So say anyways, I'll do it on here, right? So for example, right here, say we bought, right, and we're in profit. Our entry is the purple line. That's where we got into the trade actually. Sorry. Business call. Anyways, say I'm in profit, right? I'm in profit. We're making money. When you're in profit, say I want to go, and you don't have to look at the charts all the time. You can place an alert. Like I can place an alert right here. That way I'm not constantly looking at the market. So then when a price across that line, I get a ding from my phone. So okay, now I'm gonna go in and do this, right? So I'm not watching the charts all day. So we're in profit, and say we want to pull our stop loss break even. What you would do is just change your stop loss number on the side. Remember, it's numbers on the side. You would change your stop loss value and put it to your entry point. That way, when it goes back down to your entry, you don't lose any money. But obviously, you got to account for spread. So I always put it a little bit into profit. That way, you protect your money. And say it goes up even more, and you can do this at any time. You can actually take a percentage off your trade. So you can close a percentage off your trade. So if we go to modify position, let's see. Actually, I think it's close position. Shoot, I usually do it on the phone. I never do it on here. Well, we're not even up any money. But let me see. Yeah, I do it on the phone. I'm gonna have to show you guys on the phone how to do it. I'm gonna show you on the phone how to do it. But you can close a percentage of your trade. So you see how we have a 2.55 lot size? You can close the 1.5 lot size and just take profits of your trade off. So say we're up $1,000, you can take half off, which is 500. But I gotta figure out how to do it on the actual platform. I usually take partials on my phone when I'm out and about. Modify position, protection orders, not protection orders. Free. Am I tripping right now? We'll figure it out. We'll figure it out, chat. We'll figure it out. I'll let y'all know. But that's very simple when it comes to that. There are different order types, but I do want to keep it kind of focused on what you can use and what you can apply today, because it goes real deep into trading, but you do want to stay focused and, eat small bites at a time. How do you eat an elephant? One bite at a time. Don't get so overwhelmed with information. Don't try to eat so much at a time. Take what you learn, go apply it, go practice it, go try it. So from right now, I want y'all to comment what are y'all struggling with in regards to risk management. What is some hacks you have, etc., etc. But make sure you're leaving from this video right now. Like it, share it with a friend, and go practice some of these things that I'm teaching you. Practice these risk management strategies. Maybe write out a risk management plan. Maybe scale up a risk management plan. Say, okay, if I risk $250 and I have a 60% win rate in 6 months, if I'm taking this many trades a day and winning this many, how much money will I make? Will I make $20,000, $200,000? Play with it, see what it gets you, and practice. It's all about practice. So in the next video, we'll be going over psychology, which is essential to every trader. So I'll see you guys in the next video. Okay, so welcome to Trading Psychology. I feel like I have a great, unique perspective when it comes to trading psychology. I touch on a lot of things that other traders don't or don't really realize that they need to touch on. I'm currently in this trade, by the way. Trading psychology is basically controlling all your emotions when you're trading to make the right decisions and the right judgment under high pressure environment. Because obviously dealing with money, trading your money, it can become a high pressure environment quick, especially if you don't really have a lot of experience. Imagine putting $200, $500 and it's running on your trading account. You could lose that $500. Whenever you put money into a trading account, it's what's the word? It is exposed to risk no matter what. Even if you're the most perfect trader, it's still exposed to risk. Whatever money is in that trading account is exposed to risk, especially if you don't use a stop loss. So that environment can make you do things you normally wouldn't do under low pressure circumstances or situations. So trading isn't just about like strategies, mastering your strategies, but it's also about mastering those emotions, which can help you make the right decisions. So we're going to be explaining emotional challenges, how to overcome them, different things you can do for that psychology to increase your win rate, to increase your trade profitability so you can actually make more money and change your life. So you have to understand, without trading psychology, you're going to be susceptible to a lot of losses. So you have to think of trading psychology as, how long can I hold this trade? Can I endure this drawdown? Am I risking too much? It's a lot of things that go into play. So first off the bat, one thing I say in trading, if you want to help your trading psychology, just my little hack, change the colors of your candles. That way you have no specific bias when you're buying or selling, but also so that these neutral color candles, it won't affect you when you're in drawdown. It won't affect you when you're up. You just be completely neutral. And I tell people, when you're trading, the best trader doesn't care. He doesn't care when he loses. He doesn't care when he wins. The best trader doesn't care. So if you can turn on that I don't care attitude, that I don't care personality, then you will be ahead of 90% of traders. I promise you. Because if you don't have your emotions under control, you'll be getting out of trades early. Sometimes you'll get out of trades when you're in drawdown. Sometimes you'll get out of trades when you're in a trade and profit too early. Like, for instance, say I'm up in profit right now, right? I'm in this trade currently. Say I'm up $200. Some people will be like, oh man, I gotta just capture the $200, even though their target is $2,000. You know what I'm saying? So if you close at $200 and then the next trade it hits your stop loss and your stop loss is $1,000, and it's like, How can you consistently be profitable if you keep closing out your trades early? That's when, if you're closing out your trades too early, you usually have too much risk on that you can't handle. You have to be able to let your trades breathe. You have to let your trades be able to do what it does. And psychology can become a really advanced topic. And I do have amazing hacks. I can't share all of them on this YouTube course, but I'm gonna definitely try to give y'all as much as I can. But closing trades early, in profit or in drawdown. Some people will see their trade go all the way. For instance, they'll see a trade they're in go all the way down here into drawdown, right? And they'll close early. And then once they close, it goes up and it hits their profit. And they're like, dang, only if I didn't close early, only if I didn't close that trade early. But it's because they're scared to lose that money. You cannot be scared. You have to be rational and logical. And I know it's easier said than done, but that's the reality of trading, and not everybody can do that. That's why, like, not everybody personality type is able to trade, or not everybody personality type is able to trade any time frame, any time of the market, etc. Especially if it's high volatile, then your emotions go crazy. Because I remember getting in them trades, man, my psychology was horrible. My heart was beating. Hands was sweaty. Hands was so sweaty. Hands was shaking. I could not even close out my trade. That's how you knew I was risking too much. That's how I knew. So you have to understand that if you have to follow a solid trading plan. You have to create a trading plan where it's really black and white for you in the beginning, especially in the beginning. Me personally, I have a trading plan, but it's all in my head. But you need to have a trading plan that you write down. We're going to go over a trading plan in the next video, but you need to have a trading plan that you can see visibly all the time so you know what to do. You can also journal your trades. That helps with trading psychology because you're actually dissecting the trade, seeing why you lost, why you won, dating it, and seeing if you can find that same situation, same scenario throughout the charts, right? And that goes really deep, but we don't have time to go into all of that. What else do I want to touch on? Just back testing as well. It promotes your trading psychology. Why? Because that repetitiveness of testing what's working and seeing the things play out over and over and over again, it gives you a better confidence in the chart. And confidence is really important when it comes to trading psychology because you believe what you're doing. You believe that your setup, you believe that the concepts and everything that you're following, that you stand by on the charts actually work and they'll actually play in your favor. You know what I'm saying? And even when you have those wins, you have to understand that any next trade can be a loss. And you have to understand you can have a losing streak. A losing streak is very common in trading. People will have a losing streak and say, oh my gosh, my strategy doesn't work. Oh my gosh, these concepts don't work. But that's just simply not true because you will have losses in trading. You just have to make sure your risk reward ratio makes sense. You're actually holding your trades to target. You're taking partials at the right time. But it's all a process, and it's a learning process. And you can't be discouraged just from taking a few losses in a row. Just know those losses, if you're following a winning trading strategy, just know those few losses in a row, you're about to have your win streak. All that means is the win streak is about to come. And you just have to limit your risk because trading psychology, it can go as deep as you wanting to get rich quick. I know we all want to make as much money as possible fast, like really, really fast. But trying to make money really, really fast, you take trades that aren't there. You take trades that don't make sense. You hunger and you thirst after trades that aren't there. You just have to cool it. You have to understand it's a numbers game. It's a long-term game. And can I be profitable? Can I make a few million in the next 10 years? Can I make a few 100,000 in the next 3 years? Can I make 10,000 in the next year? You know, it's just patience. Because say you make 10,000 your first year, right? You might be like, oh man, I only made $10,000 first year. But then what if that next year you're able to turn that 10,000, not turn the 10,000, but you're able to do 100,000 next year. And then the next year you're able to do 200,000-300,000. You know, it's a long-term game. So if you would have quit year one only making 10,000 and then year 5 you're making $600,000, it's like, come on. Don't be discouraged so early. Don't quit so early. Your trading psychology, it really, 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 really needs to be top tier if you want to succeed in trading, controlling those emotions, because it's so easy to lose a trade and want to hop into a trade that doesn't follow your strategy at all. just so you can make a little money back. And that's a dangerous game. You just want to make a little money back, so you're hopping into this trade. You want to make the money back, and then you up your leverage, you up your risk. So say I risked $100, I lost that trade. Next trade I get into, I force it. It's not even part of my strategy. I risk $200, then I lose. Now I'm down 300, and then say, okay, I want a revenge trade again. You up the risk again, and then you win. And now you have that bad habit of, okay, I did it once, it worked. It's gonna work every time. No, that's how you lose all your money. Trust me, I've been through it plenty of times, talking from experience. That's how you lose all your money. But trading psychology is important. Change the colors of your candles, change the colors of your stop loss, your take profit. Understand it's not a rush game. Have your trading plan out. Those are just some of the small tips I'm gonna give you. It can't go deeper, but let's just start with this. Start with the basics. Start with a great foundation, because this course I really wanted to be a strong foundation. So when you're ready for the advanced, take on the advanced topics, it's going to be such a breeze to you. But this trade, this is actually currently live trade, and it is winning. Let's go. Let's make this money. I'll see you guys in the next video where we'll talk about making a trading plan. Welcome to establishing a trading plan video. I want you guys to understand in this video that trading, it is not a guessing game. It is not a guessing game at any standard. One second. It is built on a plan. Even professionals, the most professional traders, they have a plan, etc. It's not remotely a guessing game. That's what a lot of people think, and they call it kind of like gambling, but it's not. That's how you lose. If you gamble on the charts, you will lose. You have to have a well-structured trading plan. It's not just for seasoned professionals. It's crucial for anyone who wants to achieve consistent results. You have to avoid those impulsive decisions, right? And the only way you do that is by having a trading plan, because it's so easy to impulsively click a button that can make you money. Imagine having a button to click that can make you money at any time. It's so easy to click it, but if it can become impulsive if you don't have a trading plan. And it's still, the temptation is still there, because you have to have the discipline to follow the trading plan as well. Even though you have a trading plan, you still have to have the discipline to take it. So the trading plan is a guide to the markets. It provides a structure that keeps you disciplined, and it helps you measure your progress over time. So if you have a trading plan, you keep sticking to it, you can see how well it plays out during that time frame. And it's okay to keep adjusting your trading plan, but you have to stay consistent with it for a certain amount of time before you keep changing it, because it is a numbers game and it is a probability game. So you want to see how probable it is over time. So we'll go over why it's essential and the key components you'll need, and how you can get started creating your own plan from scratch. So a trading plan is just more than like a set of rules. I can't do that, but it's kind of like a roadmap in a certain way. It's like a roadmap to your success, to your trading goals. It helps you stick to your strategy. It helps you stick to your risk management. It helps you stick to any exercises or trading practices that you have. It's pretty much like a GPS. So if you follow your structured plan, you'll make consistent profits throughout your decision making with your trading journey. So we all know the markets move quickly. It's easy to make decisions driven by either fear, greed, because we all know we all want to get rich. It can be driven by a many factor of things, even your emotions and what's going on at home. That's important. Like if you're going through a lot of stuff on your personal side, your personal life, then it's like, man, it can really have effect on your trading, whether somebody passed in your family, whether even females, possibly your cycle. You have to be careful that it could, if you're struggling financially and you can't really pay bills, all that stuff can be driven factors of impulsive decisions within your trading or within your trading plan. So you have to start your goals and make some realistic, clean, clear-cut goals within your trading. With all the emotional influence, it has to count for something. So make those actual trading goals. What do I want to be able to accomplish? What do I want to make this month? What do I want to make this year? How do I want my trades to play out? You obviously can't control how much you make, but you can control how much you plan your trades and what you're supposed to make per trade if it wins, and what you'll lose per trade if it loses. That's how you kind of guesstimate. That's how you can kind of calculate what you're going to be doing. So you have to have your risk management rules. That is one of the first key components of your trading plan. After you set your goals, After you set your targets and what you want to do for, let's say, the month, I want you to set risk management goals. Meaning, am I going to risk 5% a trade? Am I going to risk 10% a trade? Am I going to risk 1% a trade? Okay, so I'm going to risk 5% a trade. Okay, how many trades will I be taking a day? This all needs to go in your trading plan. How many trades will I be taking a day? How many trades does my strategy present me with, or the opportunities that I have in a day? How many sessions will I trade? Will I only be trading what session? What time of the day will I be trading? These are questions I need you to write down, and that will actually you fill in for your trading plan. What time of the day will I be trading? What happens if I take a loss? Okay, I'm going to be taking 3 trades a day. This is hypotheticals. I'm going to be taking 3 trades a day. The first trade, I'll risk 5%. The second trade, if I lose that first trade, I'll risk 2.5%. If I lose the second trade, I'll risk 1%. If I lose that trade, there are no more trades for the day. So what if I win the first trade? Will I still risk the same percent on the next trade? And will I not trade the next trade and only take my win for the day? So you also have to ask yourself, how many wins a day do I want? You also have to ask yourself, will I trade news? Do I trade after a news event? Do I trade before a news event? Will I trade on a news day? So a trading plan can go very, very deep. What instrument will I be trading? How many instruments will I be trading? You have to ask yourself these. Where do I exit my trades? Where do I get into my trades? What if, what happens, why that, this, and that? These are questions you have to ask yourself and develop into your trading plan. But when you have this written down, it is so clear, clean cut, and beautiful, because you will be so much more profitable. You'll be ahead of so many traders. So many traders. And then also in your trading plan, where is my target? Okay, what will cause me to get out of a trade early? And this, you'll figure all this out through back testing and testing your strategy as well. What causes me to get out of the trade early? Will I ever close a trade before it hits my stop loss or deep in drawdown? What permits me to be able to do that? So trading plan can be very, 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 very deep, right? It goes into the trading schedule. You also have to journal your trades as well. That will help you. It will help develop your trading plan as well. Every time you journal a trade and you really dissect that trade, whether it's a win, whether it's a loss, you learn from your wins, you learn from your losses. You'll be able to take the important guts of that analysis that you journaled, and you'll be able to put it into an updated trading plan so you can continue to be more profitable. It's all about a journey. Does my trading plan change? It still gets a little better. It gets better probably every few months. It gets better. Why? Because I want to be the best. I want to continue to get better. And because a better trader makes better profits, gets better results, and makes more money. But I want you to understand, I don't want you to be overwhelmed with this trading plan. I really do want you to start simple. Focus on setting the clear goals, applying the basic risk management, using 1 or 2 entry exit criteria, and obviously as you gain the experience, you'll be able to start expanding and plan to include more of this and that. So in the beginning of your trading journey, if you're a beginner, or even if you're not a beginner trader, right, and you've been trading for a while, I still want you to keep it simple. If you never had a trading plan, if you never had a written trading plan, I want you to keep it simple, because keeping it simple in the beginning, it won't have you contradicted so much. It won't have you second guessing. You'll actually be able to get into trades, because we actually do want to be able to take trades. And obviously not every setup may follow your trading plan perfect. That's up to you if you're going to take it or not, literally. But you have to regularly review and update your trading plan, because it's not a set in stone type of thing. It will consistently and constantly evolve, and that's what you want to do, because you want it to get better. If your trading plan is not changing, then you're probably not learning, and it's as simple as that. If it's not changing, then you're probably not learning. It's very, very simple as that. So always review and update your trading plan regularly. So if you're looking for the extra guidance in a specific trading plan, I just know everybody in my elite mentorship, I help them develop their trading plan, and we it's not like a group thing. It's a one-on-one. Like, I'll help you with your trading plan in my elite group. But that's only for my elite members. We actually have a meeting today. I'm going to get on with a few of them. And we're going to talk trading plans. We're going to talk trading strategy and what the next 6 months looks like for them specifically. But that's only my elite members. So after this video course, you go through everything and you're constantly watching this over, you're noting and whatnot, and you're ready to go to the advanced topics and actually start making real money, then you know where to find me. So remember, a trading plan, it's essential for staying disciplined, managing your risk, and tracking your performance, because that's very important. If you can't track your performance, then you really don't know your progress, and you don't know what you need to change. You don't know what you need to fix. You don't really know what you need to adjust. So you got to remember the core components. You have to set your clear goals. You have to manage your risk. You have to define your entry and your exit criteria, which is very important. 1 or 2, remember. You have to establish that trading. You have to establish that trading schedule and journal everything as much as you can. So I'd love to hear from you guys. Have you ever had a trading plan? Are you excited for a trading plan? What would you do different in your trading plan than it is now? You know, just drop a comment, kind of be engaging. I am excited to hear from you guys. So I'll see you guys in the next segment. We'll be going over pretty much demo trading. So I know demo trading might sound like demo trading, but trust me, it's gonna take you to the next level. So I'll see you guys in the next segment. Okay, so welcome to the next segment where we actually dive and delve into demo trading. Everybody's like, demo trading. It is a vital, key, important part of your trading, but only for so long. I feel like people over-exaggerate it and overextend how long they should be demo trading and how effective it is long-term. I think it's complete cap. But you should be starting demo trading. Why do I say that? If you can see my screen. Yeah, cool. You can see my screen. This is a demo account, meaning I can place trades as you would on a live account per se. So if I wanted to, buy, say we bought, right? It's replicating the same thing as a live account would. So if you want to place your stop, usually, for some reason, I don't know why it doesn't work when you drag on Forex pairs, but it works on crypto for sway. So say you want to set your stop loss. Say we want to go 153.763. So I recommend demo trading only to understand how all the mechanics work on whatever platform you're trading, whether it's Osprey, I'm going to link that in the description so you can sign up and make a trading account, or whether it's Sway Markets, I'm going to link that so you can sign up and make a trading account. It depends on, it doesn't depend on anything, but it's to work the mechanics and see how the mechanics work, as well as actually trying to catch trades using your trading plan and strategy before you use live money, because you want to be really familiar with getting in, getting out of trades, managing an account, journaling trades, progressing an account before you start trading with the real money. Why? Because the point of real money is to practice and get that experience for your first deposit, but also the point of real money is to actually make money with that trading account. And you can't make money if you don't know what you're doing, if you don't even know how to work the trading platform. So first things first, with demo trading, I say demo trade for probably around 2 to 3 weeks, consistently actually trying to catch your strategy, consistently trading the sticking to your trading schedule, whatever you put in your trading plan. So that's like, I'm going to trade at the same time every day, actually catching these trades, because it's so vital and so important to actually see your trades play out like in real time and you seeing like a little bit of money. But you could even, the way demo trading works now, well, actually it's important to demo trade like this, but you could also back test on simulated accounts where you can rewind the time and fast forward. But this is important. This kind of demo trading is important because it adds that, it takes away the ability to fast forward. So it adds that patience that you must have when trading. Like you have to have a kind of patience for this demo trading. As you can see, look how slow the charts are moving. Cool, we up $8, up $9. And say our target is, for instance, say we want to take out these relative equal highs, which is at 153.965. So say I take profit 153.965. So right, say our take profits up here. And this is a 1 minute time frame, so I was gonna go faster, but it's patience. It takes patience. You have to have patience for this specific kind of demo trading. But it emphasizes that it helps beginners Build that confidence, practice your strategies, understand how the markets actually work and how you can feel it in the live markets conditions rather than just looking and forward testing and look at what's already happened, but you actually get in, right? But it's easy to set up a demo trading account. You can set up a demo trading account with Sway. You can set up a demo trading account with Osprey as well. But I recommend only trading demo for 3 weeks. You can push it to 4, but some people say like 6 months. I'm like, bro, that makes no sense. Why? Because it takes all emotions out of it. I don't care if I lose this trade. Why? Because it's not real money. Some people say, oh, they care because it can mess up their progress. It can mess up their track record. Me personally, I don't care if I'm losing the money. So it adds no emotion. It adds no real like live emotions to it, which is important when decision making. You have to practice that, like we talked about earlier, pressure with your decision making, right, and your judgment calls. So this will help you practice your strategies. It will help you learn discipline in your strategies. It will help you track your performance as well as learning risk management within that time for when you're ready with money. And then when the live trading account comes, which is still the same platform, it's just if you pick a live account or a demo account, it's very simple to set up and it's very self-explanatory once you get on the platform. It gives you a login, then you log in on a platform, and y'all can always comment if you need help. Comment whatever steps you're stuck on. I can always help and even make a video if need be. But I want you to understand that when you do your first deposit, you're probably gonna lose it, right? It's real money. You're probably gonna lose your first deposit. And I know you're like, oh, we're gonna lose money. I say you're gonna lose your first deposit because you're new at trading. You don't really know how to trade yet. It comes with time. It comes with experience. It comes with chart hours. It comes with studying. It comes with due diligence. And doing the same thing over and over and over and over again and getting that repetitiveness in so it can brand itself into your heart, into your mind, right? And so when you put in that first money, it's going to add a lot of emotions. You may gamble a little bit. You may see yourself breaking your rules. You may see yourself not following your rules a lot. You know, it's all about just getting comfortable, just getting started. You might lose your first deposit. You might lose your second deposit, third deposit, fourth deposit, fifth deposit, but you have to be learning. I always say, like, if you don't learn from your losses, it's just a loss. Like, you have to intentionally want to learn from your losses. If not, then it's just the L. You have to take to the chin, and it sucks. And sometimes you just lose. It's not really a reason why you lose. Sometimes you just lose. Sometimes your strategy just won't work that time, and it's okay. So definitely start with $100. Start with $100. If you have more, cool, but don't ever put all your money into a trading account. Never put all your money in a trading account. If you only have $1,000 saved in your bank account and you're working a 9 to 5, put $100 into your trading account and stick with that 100. Don't try to put 500 in. Don't try to put 800 in and say, oh, I can do off this little $200 till next paycheck. Don't do that. Only put a little bit in. You do not want to exhaust your funds. Why? Because then you start forcing it. You start feeling like you have to make certain trades, but you really don't. It's a long-term game, and it's a patient game. So play the patient game, but add those emotions into your trading. It's gonna be a different experience than just demo trading. Because demo trading, you can just hop in whenever you want. Look, hop out whenever you want. Live trading, it's a little more. You feel me? It's a little more gun to it. So with live trading, it will give you the things that demo trading can't. But it's important to actually just get familiar with demo trading and how everything actually works. It's very valuable and it's definitely a stepping stone, but there's no rush to making real money. So even if you feel like you're not ready to trade real money, then don't. But at some point you do have to do it because the whole point of trading is to make money. But don't expect to make a lot of money off your first deposit. Honestly, expect to lose it. Some people don't lose their first deposit. Me, I lost plenty of deposits, but that was just me. I didn't have a mentor. So, but if I had me, I probably lose one. But nah, I ain't gonna lie. If you were my elite mentor soon, you're not gonna lose any accounts. So after you finish this, make sure you get started with that. But demo trading is very simple. You just learn how everything works, learn all the tools, play with all the tools, play with all the functions, modify trades, etc. Plan out your trades. It's all about practicing. Practice, man. Practice makes perfect. But that was the segment on demo trading. I'll see you in the next segment. We will go over common Forex mistakes you have to avoid. It will change your life. So I'll see you in the next segment. So in this video, we're going to be going over the top 7 mistakes you need to avoid as a trader, especially in the beginning. If somebody told me these it will be life changing for me. I'm telling you. Forex, it's not about what you do right. It's about avoiding the cost. Avoiding the ones. Avoiding those costly mistakes. I'm telling you, it can hurt you so bad. Mistake number one, over leveraging, putting too much on a trade, or you could even call this revenge trading as well. Over leveraging, going full margin when you're putting your all onto one trade, all onto one setup, risking too much. Over leveraging can wipe out your entire account as quick as you put the money in there. When you're putting too much account, say you have a $100 account and you're risking $70 on that trade, it takes one trade for your account to almost be gone. That is one of the largest mistakes. And in the beginning, that's what I did. I would literally go full margin. I would click buy, and no stop loss. I wouldn't even put a stop loss on my trade. I was the definition of over leveraging. I was the definition of over leveraging. I would put as much as I could into a trade. Why? Because I wanted to win as much as I could out of a trade, and it never worked. It doesn't work long term. You can get these quick wins, these quick gains, and sometimes it hits, sometimes it doesn't. But most of the time it won't, and most of the time it will blow your account. Even sometimes it hits. It only takes one time for it not to work, and all the progress, whatever you did, is gone, is bye, is finito. It doesn't work. So please, please don't over leverage your money. Over leverage your risk. Even if you're borrowing for somebody, if you're trading, managing funds, you can't over leverage. You stick to your trading plan. Please, please don't over leverage. Don't put too much into the trade. Mistake number two, lack of a trading plan. It's like navigating without a map in the jungle, and you're trying to get somewhere. Right. You're trying to get somewhere. It will lead to impulsive, emotional decisions, and you will do things you never thought you will be capable of doing on a chart. You will be making the dumbest and stupidest, most idiotic mistakes just from having a lack of a trading plan. Why? Because you're trading with emotions. You have no guide. You have no roadmap to your success. You're just free balling it. Balls are swinging in the air, getting breezed on because you have no map. You don't know where you're going. So it's so important to set the specific goals, have your risk management, have your entry and your exit criteria. It's important. It's so important. And you're more likely to take inconsistent trades and face unnecessary losses. The worst thing you can have is an unnecessary loss, a loss that shouldn't happen. And it happens in trading, but you can avoid them majority of the time. But there's sometimes if you don't have that trading plan, it's a loss that should never happen. This didn't do this. This didn't do that. So I shouldn't have even taken this trade. Come on, man. Lack of trading plan. Don't do it. Another mistake. Number 3, ignoring your risk management. Ignoring how many trades you said you were going to take a day. Ignoring the percentage of what you said you were going to put on those trades. Excuse me, choke a little bit. Ignoring what you say you were going to put on those trades, ignoring all the risk management plans you had, ignoring that you say you were only going to trade one pair. Next thing you know, you're trading a whole bunch of different pairs with the same amount of risk on all of it. So now you're risking 1% per trade, right? But you're on 5 different instruments, meaning you're in 5 different positions with 1%. So now you're risking 5%. So it's like ignoring that risk management. You have to have your risk management, like not using a stop loss, not calculating your position size, not increasing your position size after a loss, like to win back your money. Like you're not winning that back by revenge trading. Please do not ignore your risk management. Mistake number 4. Ooh. If everybody followed this, we'll be cool. I promise you. Chasing those losses or revenge trading. Revenge trading basically is when you try to make the money that you just lost back by risking more money, and it often leads to a bigger loss because it's fueled by emotion rather than strategy or your disciplined trading plan. And I've seen it get bad where people blow $100,000 accounts, $600,000 accounts. They'll lose one trade. It's okay to lose. You're supposed to lose in trading. You will lose in trading. You will have your losses. They lose one trade, they risk more in the next trade, and they lose that trade, and they risk more in the next trade. They lose that trade, so now in 3 trades they're down 50% of the account. Then they're like, okay, I got 50% of my account left. If I risk 50%, then I can gain that other 50% back, and I'll be break even. Then I'll stick to my trading plan. It doesn't work like that. You risk that 50%, and you sure will lose it. And if you then do win it back, you'll say, oh, I just made 50% one trade. Let me risk 50% again. It's a bad cycle to go down to. It's a bad rabbit hole. It will hurt you bad. Just please don't do it. Mistake number 5 is over trading. Trading too much. Taking too many trades either from boredom or the belief that more trades will lead to more profit, and it absolutely won't. Take those good trades. Take those high probability trades. Please take the high probability trades. Don't try to just jump in and jump out of hoops by seeing, okay, I want to take more trades. I have to take more trades. It doesn't work. Or even when you're on social media, you'll see, oh man, he just made some crazy profits. Oh, let me get on the charts. Let me trade. Please, please, please don't make moves like that. Mistake number 6. Sorry, I only have 6 mistakes for you. I said 7. I know I capped. Mistake number 6, focusing too much on short-term gains rather than long-term gains, right? You're focused on the hour gains. You're focused on the daily gains. You're focused on the weekly gains rather than focusing on the monthly, yearly gains. I know it sounds so long, but think about it. You have a bad 3 weeks. You're down 10% on your account, but then on the year, you're messing around. You're making 100 to 200% of your account. Like, it's okay to lose. It's okay to have a bad week. Bad month really, really sucks, but it's okay to have a bad week. Like, it's a long-term game. Focus on the long-term gains, not the daily gains, not the couple-day gains, not the weekly gains. Focus on the long term. Please focus on the long term. It will save you. It just works out better. I know everybody wants a quick check, quick to $10,000 a week, but what if you can just do $10,000 a month, or what if you can do $10,000 every 3 months? Like, just keep it slow. Let's first start on making it replace a part-time job. Then work your trading into replacing a full-time job, right? Then work on it thriving for you. That's how you want to move. You want to go slow. Start small. It's okay to make $20 a day. $20 a day, what? Extra $600 a month. Cool. That's a what? Extra $7,200 a month you could have. $200 you could have in your savings at the end of the year. So just remember, avoid those common mistakes. Avoid over leveraging, lack of a trading plan, ignoring risk management, chasing the losses and revenge trading, over trading, and focusing too much on the short term rather than the long term. And you will be good, I promise. But in the comments, I want you guys to let me know which one of those you have dealt with, which one do you think might be hard for you, and just any questions you have. So in the next video, we'll be going over next steps and basically just what you should do after this video. So we'll get in the next segment. I'll see you there. Man, welcome. Thank you. You finally made it pretty much to the end of the course. I want to thank you for watching this all the way through and for joining me on this Forex trading journey. Learning Forex, it is truly a commitment. It actually takes time, it takes effort, and it takes patience. Whether you're just starting or you have been trading for a while, I appreciate you sticking with the series and dedicating yourselves to becoming a better trader. In this video, we'll be going over the key lessons covered throughout the series, and I'll share those next steps for you who are serious about advancing their skills and taking their trading to the next level. So I want you to understand the foundational topics we covered. It is so key that you go back and watch this video multiple times and that you actually take notes and take notes again, because obviously when you go through something once, you'll get certain things from it, but there'll be plenty of things that you miss, especially because you don't know, like the Forex and currency pairs, right? The basics of it. We started with an introduction to the Forex market. And we explored the major, the minor, and exotic currency pairs, as well as a bit in how ask price works. And then we went over the market hours and the sessions. We went over pips and lots and leverage. We went over charting and technical analysis. We went over fundamental analysis. We went over risk management. We went over trading psychology. We went over demo practice and real trading, and we went over the common mistakes, which all are key and vital parts of your trading. But remember, practice makes perfect, right? practicing anything, especially trading. So you have to continue to refine those strategies, journal each trade, review your results, and always comment and message me when you have those questions. But here it all is, and I'm laying it all out. If you're ready to take your trading to the next level, my mentorship program is here to guide you. This isn't just like a basic education. It's a comprehensive hands-on experience. It's very intimate, and you'll learn advanced strategies and receive personal feedback and get the insights to actually navigate the market profitably and confidently. So in the mentorship, you'll have access to live trading sessions where you can see strategies in action in real time. We'll have those live Zoom calls with intimate, personalized teaching. So you'll never feel lost or overwhelmed because I'm always right there. You'll actually have my personal phone number. I'll be here to provide the close guidance, the hand holding, so you'll never feel lost. And through each step, you make sure you understanding and can apply each concept. Plus, the program comes with a 90-day profitability guarantee. That's my commitment to helping you reach your goals. And if you're not profitable within those 90 days, I won't stop until you become profitable. Do you hear me? I won't stop until you become profitable. So trading is a journey that requires the dedication, the discipline, and the structured approach. With the right mindset and solid foundation, I believe anybody can become a successful trader. If you're serious about taking your skills to the next level, check out my mentorship. It will be linked at kinowealth.com. Click kinowealth.com down below in the description and sign up. We'll be able to start off with setting up a call and actually talking to you, getting on a Zoom, and making sure this is right for you, because it might not be right for everybody. But be sure to subscribe, follow, share with a friend that needs to learn about Forex. And to stay updated, also follow me on my Instagram. So like several videos, I've hinted at many advanced concepts and many advanced tools that we dive deeper into the mentorship, like unique indicators, market structure insights, and specific entry and exit strategies. In this video, I just hope this was great for you, and I hope you learned a lot, and I'm really excited to take you on to the next level of your trading journey. Make sure you like, subscribe, comment. It is Kino Money, and I'm so happy I brought you along this journey. But let's get this real money, and let's make some real money. I'll see you in the mentorship. Peace.